Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Ricus Reeders, PSG Hole in One, Ruimsig, Mutooni from Sanlam Investments. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter at BusinessDayTV, #Stockwatch. James, thanks for the time this evening. Roy, let's start with you. I want to touch on US jobs. We've got some ADP and the like today. Of course, the big number is tomorrow. We're going to get unemployment, and that all leads into FOMC in 2 weeks. Your thought on what we saw today and what we're looking at for tomorrow? We're expecting a bit of weakness, are we not?
Yeah, I think that's what's baked in the numbers. I think even today just showed you that there is some weakness creeping into that labor market. Clearly, tomorrow is the number that everybody follows, but that I think is the narrative that's building in the market right now. The job sector is weak, inflation is growing, and there's probably a need for lower interest rates to come through. So, yeah, let's see how it pans out.
Ricus, you agree with that? That certainly is the narrative, that jobs are weak, we're ignoring inflation, and we cut rates on the 17th.
Yeah, we had ADP numbers out yesterday, and it's the first time, and I don't know, it's a very long time, a couple of years, that there's now actually more people or job openings than people looking for work. So it's not merely one number, it's a series of numbers that are pointing to a weaker labor market. Obviously, you can argue whether lower interest rates are going to help that situation, but I think that a September rate cut is definitely now, 99% probable.
Yeah, I think that ADP was the first time since, certainly since pre-pandemic, more seekers than actual jobs available. Next to go to some data, Ricus, let's stay with you. We won't get Roy into this because of his background. Sanlam results, Ricus, I got to say, two thoughts struck me. The first was, I don't know how they're growing in an economy that isn't, I suppose. And the second is, I don't know why the market shows violence.
Well, your answer to number one is Roy, because he's solely responsible for all that growth.
You're very kind, Ricus. I'll take that.
Yeah, but I thought it was pretty decent. I mean, as you said, they are making hay not while the sun shines, but while it's actually sort of twilight as far as as far as our local economy is concerned. Obviously, India helped as well. Some weakness in the market, which is, not because of anything Sanlam did wrong. It's just the economy. So the price is down 3-4%, and not because it was bad numbers. I think it just because it was as good as it could be.
As good as it could be. That actually, I suppose, makes some sense. Roy, let's touch on Telkom. Big day on Telkom, up 13% today. A Bloomberg story that MTN is going to make another bid for them. This after they had talks a year ago at about half the price it is now. My thought is, does Competition Commission even have a look? Surely this is going to be a struggle to get across the line.
Not even that. I don't see the incentive for Telkom to do a deal. If you think about it, when they last spoke, Telkom was overloaded with debt. The mobile business was not generating cash. MTN was flying. Things were good there. And subsequent to that, Telkom have gotten rid of the towers business. Mm-hmm. Their debt, their balance sheet is debt-free, absolutely. And then standing right next to them is Vodacom, who've paid a supremely premium multiple for what I would call an inferior business. I know Shamir will shoot me for saying that, but effectively that's that. So if you're sitting in Telkom's shoes, what do you want to do right now? What you want to do right now is just sit pretty and keep executing on what you're doing because it's working out. MTN, on the other hand, I see no reason for them to do this. I know the market will say they need to get into fiber and all of that, but right now, They're making hay while the sun shines in Nigeria, in Ghana, Cote d'Ivoire, in Uganda. It's all doing well. SA, so long as it just holds on, is doing incredibly well. Why would they want to get involved in more regulatory problems when there's DOJ, the SA business is not doing that well? To me, at this point in time, it doesn't make sense for either of them. But clearly somebody in the market knows something, and Telkom was up 13%. There can only be one winner. I mean, Telkom would say, if we're going to talk, we talk at the price that was paid for Massive. I mean, that's a rich price. And there would be no hurry to do a deal.
I take your point. It is a rich price, which means if I'm a Telkom shareholder, do I just hang on at this point? I mean, the stock's up more than doubled off the lows. But, I mean, as you say, there's no debt out there. There's maybe someone who wants to pay a significant premium. It's a Telkom shareholder. You just sit pretty.
Precisely that. Roy made the case for Telkom. Yeah, maybe MTN is feeling adventurous. I think they walked away from the deal last time.
Yeah.
Now it's double the Telkom price. They're back. So weird. But yeah, if I'm a Telkom shareholder, I'm pretty happy with what the company is doing operationally at the moment. And yeah, if somebody comes and bids at a premium, I would hesitate to accept it. But on the other hand, it is a premium.
Yeah, and they must come and put some cash on the table. We stress these are rumors from Bloomberg. We've had nothing on sense from either company. Ricus, let's stay with you a moment. Paper companies, and they're separate questions, but I'm going to put them together. The one is around Monday is the opportunity here. The other is, surely Sappi is a dripping roast. I've got to stress, dripping roast is not my words. I've long sworn off paper companies. Monday, Sappi, either, neither, both. Ricus, for you?
Let's talk about Sappi. I've long since not bothered to take a look at Sappi fundamentals because it's so variable. You know, it's either feast or feast. So I trust very long-term monthly indicators, and on that basis, if you can stand the volatility, I mean, you know, that share price can decline 25%, no problem. Or it can go up 25%, but on a very long-term monthly basis, it is in that region where previously, over decades, it's had a run. As to why that would happen, don't ask me. I'm just looking at numbers on the graph. Mondi, well run in Europe, but it's not an exciting company. I mean, I like their product line. I like the way the company is run. But if one is looking for any type of economic revival in Europe, it's not going to start with packaging. It will end with packaging, I think.
Yeah.
So you might be stuck at current levels for a while. Whether it offers good value or not, on a fundamental basis, probably. But one does need general optimism in Europe to get that share price going.
Yeah, and I like your point. Packaging is going to be late in the process. They're not going to lead. Roy, Sappi, Mondi, either, neither?
Well, the thing about Sappi is, exactly like Ricus says, that share price really moves. But remember, they live in a world where, to grow earnings, a lot of capacity has to be taken out of the industry. And we've been going through this cycle for a long time. So I think what investors hang their hats on right now is the DWP prices beginning to accelerate and believing there's operational leverage because they've taken out some capacity. I think you need significant growth for this to make sense. Mondi, like Ricus says, great quality, good management, executed well. Clearly the Russia thing really burnt them, really hurt them, took out a big nexus of growth for them. But packaging requires trade. Trade's the biggest swear word in the world right now, so it's not going to happen. So you can buy it. It's really cheap and it's great quality, but you're going to hold for a long time until you see actual GDP growth coming through across both. Sappy, like I said, you need a lot of capacity to come out. You need those DWP prices to keep
Yeah.
rising. You're betting on a lot, on a very low quality business.
Yeah,
Remember, there's
absolutely.
gearing there as well.
Yeah, but I'm going to raise your swear word, and maybe this isn't a swear word. You'll let me know. Aspen. I mean, we knew the horror numbers were coming. It's been a horror year for Aspen. They've written down, it seems, almost everything except perhaps the CEO's parking space. Roy, is there value here, or is it that management's disappointed too often, and we need to see some proof in this pudding?
Look, there's a price for everything, without a doubt. And you can do your sum of the parts and write off everything and all that, and you'll probably get to a point where the current level right now discounts a lot of bad news. I think the problem is the narrative from management has not actualized over time. Everything they've promised ever since COVID, none of that has ever come true. None of it has actually happened. I mean, they've always had solid blue sky above them, but it hasn't delivered. So I don't think anyone's listening to their promises right now. I think what everyone wants to see is some level of execution, some level of returns, and then you start looking at the stock again. It's going to take a long time for investors to take them at their word, as they did in a few years ago. So yes, it's probably cheap. Yes, it's probably pricing in a lot of bad news, and maybe on a sum of the parts basis, you're getting aspects of the business for free, but I'm not sure why you'd want to be in this one right now.
Yeah, Wayne McCurry always reminds me, the market has memory, and you've got to move past that memory in a sense. Ricus, would you be jumping on the Aspen, or are you in the same? Let's rather let the dust settle.
Yeah, no, I'm with Roy on this. You know, there might be blue sky, but that's only because they're at the bottom of a well. They've got to get out of that well first, and that's, you know, it's not merely confidence in the financial statements, but confidence in management as well. Those things absolutely must go together for a share price to move.
Yeah, they've got to get that. It needs the market to come back and love them to get it moving higher. Where I like your point, a price for everything, but what's going to push it higher? Ricus, a couple of questions coming on Sasol, and I know we chatted a bunch of it. Well, we chatted a bunch about it, and you kind of liked it as it was moving up to the 100 level. It's now. Actually, it's back where it was a year ago, 120 plus. Two questions. Is there still opportunity here? Should I hang on? And the second is more around oil. How sensitive? If we see oil sell off, how bad is that for Sasol? Ricus?
Not good. I think cracker differentials is probably more important, but let's face it, you know, even with today's little down move, we've got an OPEC meeting over the weekend, probably increase in production. That might hit the oil price. It's not going to be good for the Sasol share price, but I'm talking my book, obviously, because I bought some, and I still think the price momentum is still positive. So I'm hanging on, but very aware of keeping stop losses in mind.
Yeah, it's someone, and I forget who it was, standing close to the door. Roy, some Sasol for you? Certainly a lower oil price in the current chemical environment would be really bad for them. But your thoughts on Sasol? It's doubled off the lows, in fact more than doubled.
So the thing is, it's Rand oil prices that matter for them. Rand is strong, oil prices coming down, so that's negative. But what's driving the stock right now isn't so much the commodity side, it's the management credibility and execution of all the promises they've made. So it's quite clear there's a path towards paying down the dollar debt, generating more cash, cutting costs, looking at Secunda, refreshing their coal and cleaning their coal and all of those things. And the market's buying into that because there's inherent value here, substantial value. But previously, we were all worried that that dollar debt would hurt them, and compound that to the cyclical side of that whole world would really burn them. But now you've got a management team that I think people want to believe and who have started delivering, and that's the underpin on the stock price. I mean, if oil prices fall below 60 substantially, I guess all bets are off.
Yeah.
And you'll see a reaction. But so long as they remain between that 60, 70, 75 level, I think it's about management executing, cutting costs, paying down debt, generating cash, potentially paying out a dividend, that's what people would be looking at. So that's I think those are the parameters there. On the one hand, it can be very cyclical. On the other side, it's about watching management deliver.
A question, and coming in a couple of parts, but broadly the question is, if we see equities going down the tubes, would that impact the JSE? If we see US equities going down the tubes, would that impact the JSE? I mean, if it's a broad sell-off, potentially. The other part is there a way to hedge against such a calamity? Now, my story is quite simple. I spent, 4 or 5 years hedging ahead of the financial crisis, and when it came, I felt so clever. I ran the numbers, and I'd paid more for the hedge than I'd actually got from it. But, Roy, I mean, do you look out at markets sometimes and think that you need to hedge? And if you did, what would you use?
Oh, no. I think as an equity investor, I look at the long-term line and I say every time it goes down, it's going to come up somehow.
Yeah.
It may take a long time. It may be in zags. It's going to come up, and that's what we pay for. So the easiest way for somebody like me to hedge is to move between cash and maybe bonds. Disasters happen when bonds move in the same direction as equities, and there's no hiding there. If you were lucky, you got into cash early enough. If you weren't lucky, you just take the bath and become a long-term investor. That's what happens to people like Ricus and me. You become a long-term investor and life goes on. I guess people who are in the guaranteed return sphere have to find some way of ensuring they earn their CPI plus 5, CPI plus 3, and all of that. But for me, it's more about earning power, long-term earnings, and picking at the bottom and just remaining invested through the period. I would say that's how I would rather think of it.
Yeah,
than hedging and using derivatives, and that's difficult. You get it wrong most of the time.
Yeah, well, I was using put warrants, and long dated out the money puts, they were great, but as I said, the math didn't work out. Ricus, the other problem is you can go into cash, but if you get your timing wrong, and you almost certainly are, it's going to be painful. I mean, we're sitting right now with US markets just off the highs. It sounds crazy, but here we are. Do you get worried and jump to cash or hedge portfolios, or do you take the view that, over time, charts go bottom left, top right if you're in quality?
Yes, on the last point, so I don't jump in and out of cash, but it's my old mantra. It's not about time in the market; it's about your exposure to the market. And what Roy says, if I'm uncomfortable, I increase the cash or bond portion of the full account, and if I'm more optimistic, then I decrease it. So you manage your risk by managing your exposure rather than going full in or full out or trying to get the top or the bottom. I'm always late on the upside. I'm always late on the downside, mainly because I follow market momentum but waiting very, very conservatively for moves to confirm whether to the upside or the downside, and then you catch the middle.
Yeah,
and that's great, because then you get consistent returns.
Yeah, reminiscence of a stock operator, the bit in the middle.
Add one,
Roy.
If I could add one quick point. I was reading a newsletter today. Pete Fullion writes a very insightful newsletter that comes out on Thursday. And his point was that the more you trade, or each time you put yourself in a position to trade, you increase the risks of making a mistake.
Yeah.
So in actual fact, what you should be thinking about is holding a forever portfolio. So what you hold should be something that you want to hold for a really long time. That diminishes the likelihood that you'll make a mistake. And thinking about markets are up, markets are down, there's politics, there's all of these things. So, and I think that's a very useful point for most individual investors to consider.
Yeah, that was a good point. Every time you buy something, there is that risk. That then brings me to my next question, which came through, which kind of ties in with what you were saying, Roy, and talking around Alphabet. And they say, please help me stay in the stock. I've owned it for about a decade. I've probably up 6 or 7-fold in profits. It makes me scary, but it's still high quality even at these levels. Roy, Alphabet, I mean, it is, when you get into a good stock, sometimes it feels scary, but the right thing to do is stay the course. And I mean, I would say Alphabet's a good stock. Do you concur?
So the thing about it is, the reason you backed it from the beginning was it's effectively a platform.
Yeah.
It's a platform that generates a lot of cash, owns its customers, owns its markets, and has continued to innovate over time. Every so often, somebody will catch it on one of its verticals or something like that, but they've shown through thick and through thin, they've continued to deliver. So when people are complaining about high multiples and everything, you just stick to it and keep going. There really is no harm. If you do decide to recycle capital, because capital is restricted. I mean, you don't have infinite amounts of capital. I think it's one of those ones that you hold, maybe sell off a little bit, look for other things. But that's the trade. You see, you're trading, you're taking a chance. You think you're going to find something that's going to match it. So if you've done well in it, stick with it, stay in the ride. It will pay off. Unless, of course, something dramatically changes, or you think something's going to dramatically change over the short to medium term.
I take your point. And in the case, I mean, they've had some missteps, but I mean, I was digging into Waymo earlier in the week, and I mean, just Waymo is an astounding little business, which I don't think we fully appreciate. Ricus, your thoughts on Alphabet?
Well, Alphabet, all stocks like Alphabet, if I can make it a bit broader, if
Sure.
you're that kind of behemoth as far as growth is concerned in a sector that is screaming for attention, then you have to be able to sit with it, even if you go through, a stock like that can decline 20-25%. It did so 2 years ago.
Yeah.
And recouped it very quickly and still going on. So you have to be able to stomach that return. But don't get into a position where that is your only biggest asset, because that is inherently dangerous, at least from my own personal viewpoint. Use some of that capital that you've generated and look for the next Google type of company, not the same business, but somebody that's at the start of a growth cycle that is unique and not merely doing the same thing, but aggressively moving into a sector that might be overlooked or have an angle that it exploits in a sector that is already growing.
It's up 8,322% since listing. It's an astounding return. Afrimat, got a couple of questions coming through around Afrimat. They did a business update, was it last week? The market seemed unconvinced. Ricus, this is, I suspect a lot of it is going to be around Lafarge. Do we wait for more colour with results? Do we jump in at this time, or do we just stay away for now?
The price momentum on that on the short term, in other words, daily price momentum, is still pointing very, very much downwards. So it's currently at about 37, something like that. I mean, it can go to 30. Just looking again on lines on paper, that, but it, as Roy said right at the start of the program, there's a price for everything, and considering the potential in the assets they've acquired, it will need work. It will need the right economic circumstances, both locally and overseas, to get those assets sweating. But at some stage it will become viable. But at the moment, I'm concentrating on what the price is doing. And to me, it's too early. As I said, I'll probably miss the first 10% on a turnaround. But I'd rather wait for the price turnaround to happen before I start giving attention to it, which I will, because I still think it's a good company, well run, with viable assets.
Yeah, no, good. I take your point. And I mean, it's not a pretty chart. Let's not catch falling knives. We need to go to some stock picks. Roy, you're going with Bidvest.
Yeah, so they announced their results this week, and they sold off quite significantly. And you're in a position here where you've got a stock that typically trades at a premium to SA Inc., but now it's at a discount at a point in time when their earnings are actually at a bottom. So there's a few cyclical things that happen there. But I think the most important thing about Bidvest is they've gone through a 3-year cycle of investment. I mean, they've done like 20 different acquisitions, and they're bedding them now. So people complaining about their debt or worrying that they're overgeared should look over the next 12 to 18 months. They'll start deleveraging, they'll bed down those businesses, and then they'll end up with a really big, efficient, high-returning international services business and pay down their debt as well, and then recover in terms of volumes at the ports here and all of that. So I think it's a solid business. For once, you're getting at a single-digit multiple, and at the bottom of its cycle, your margin of safety here must be considerable. So this is one I really like from this results season.
Yeah, and I got to say, I didn't think the results were so bad. I mean, maybe it was that debt that the market is spooked by, but yeah, 100% on that. Ricus, Amazon.
Yes, Amazon's results came out and the share price took a knock because the market didn't like Amazon Web Services outlook. I think they sort of forgot about the rest of the company, but there's that's the first point. So I think the pullback is probably a buying opportunity for, as with Google, and a company that you really cannot ignore, and I don't think excessively cheap, even at the historic price on it's about 32. The other factor is Trump and his beautiful tax bill. Amazon and a couple of other companies are going to get an enormous tax break on the new legislation. Amazon specifically, a tax decrease almost equal to about half its projected cash flow this year.
Wow.
It'll do wonders for your valuation. Not going to do a lot for cash flow, but it will influence things like depreciation going forward, stuff like that. So it's changed the valuation numbers on Amazon. And then thirdly, it's still going into other avenues. I mean, it's just did its first deal for its Kuiper satellite internet service with JetBlue announced today. So there's still lots of other growth revenue or growth vectors in the price, and I think it's not a bad place to start looking at it.
And its return since listing, and we're all sitting down, 260,000% since listing in the 90s. That's all for Stockwatch today. Thanks to our guests, Ricus Reeders, PSG Hole in one, Ruimsig going with Amazon, Mutooni from Sanlam Investments going with Bidvest. Up next at the close, stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.